is Mark Cronenberg, and I'm the founder of Math123, and we specialize in private home math tutoring and test preparation. We also offer tutoring online. Today we're going to talk about inflation, the hidden tax. And businesses lose customers if they raise their prices by too much. So to keep prices as low as possible, businesses control their labor costs to stay profitable. As a result, salary increases are likely not to keep pace with inflation. How might this affect your purchasing power and funds available to invest? Let's take a look at an example. Let's say you have an income of $100,000 per year and you get a 2% raise this year, but the rate of inflation is 7% a year and may persist for years. What if this happened for the next 5 years? What would happen to you in your financial situation? So suppose this is where you are before your raise in inflation. Here's your gross income of $100,000, and let's say you're in a 40% tax bracket. You say you're taking home $60,000, but then your expenses are $40,000, and you have $20,000 a year left to invest. So if you didn't take into account inflation, you can make almost 11% a year on the market, and that's the 50-year return. So let's say you took that $20,000 and using our annuity due formula, you invested that for the next 5 years, $20,000 a year every year, you'd end up with nearly $138,000. But if you get a 2% raise each year and an inflation rate of 7% a year, the purchasing power of your income will be reduced by about 21% to $78,719 in just 5 years. So effectively, you have a pay cut of about 21%. As a result, you're going to have less available to invest. So here's your situation 5 years from now. So previously your gross income was $100,000, and after five 2% pay raises, you have an income on paper of $110,408. And the IRS looks at that and takes 40% of that new higher number, and here's your new tax bill. Previously $40,000, now it's about $44,000. So you're already losing $4,000 just due to taxes. Then take into account your expenses are going to go up. And then instead of your expenses being $40,000, now they're going to be about $16,000. So you just lost another $16,000. Overall, you lost about $20,000. So you gained about $10,000 in your income. So the bottom line is you take your $110,000 salary, you lost roughly $100,000 in taxes and expenses, and now you have roughly $10,000 instead of the $20,000 to invest as you had before. And accordingly, you're going to end up with about half as much. Your nest egg previously was about $138,000, and now it's roughly $69,000, just a hair under $70,000. So the bottom line is that your 2% raise plus 7% year inflation equals a pay cut of about 21% in 5 years and a nest egg that is reduced by nearly 50%. Now, recall from our Rule of 72 video about doubling your money, the inflation-adjusted return of the S&P 500 for the last 50 years is 5.4%, roughly half of the number we used above, the non-inflation-adjusted return of the S&P. So, I hope you found this helpful and informative, and if so, please visit us at math123.com and call us at 888-MATH123. And as always, please remember to like, share, and subscribe. Thank you.